Hi, everyone. We are here on our monthly webinar, Digital Assets Fund Structuring and Taxation. We have put together a good panel for our participants. So let me make my intro, and then I will ask everyone on this panel to introduce. So I'm the founder of Akram Insurance Advisory and Tax Fund. We provide accounting, audit, and tax services to hedge funds, private equity, venture capital, family offices, and digital assets fund. Kevin, please go ahead and introduce yourself.
Sure. So I'm Kevin Cott, the founder and principal of Cott Law Group PC. We're a boutique law firm based in Atlanta. We specialize in working with investment funds and advisors. That's really our entire practice. So working with investment managers on really all types, so startup and emerging managers to larger institutional fund clients. And then we work with all assets classes, so everything from traditional hedge funds to commodity pools to private equity, venture capital, real estate funds. And really for the last several years, we specialized in working with cryptocurrency and digital asset funds in particular.
Awesome. Paul, please.
Hi, I'm Paul Weimer. I'm the founder and portfolio manager for the Amelyore Digital Assets Fund. We're a crypto hedge fund, Cayman-based with U.S. management company. Been operating up and live for about 20 months and pretty active in kind of just active digital asset management.
Steve.
Sure. Hi, I'm Steve Rosen. I'm a senior audit manager with Akram Associates. Most of my experience is on the audit side. I do get into the tax piece occasionally, and I've been in the audit industry for well over 20 years.
Celu.
Hey guys, I'm Celu Ramasamy. I've been kind of like investing in the digital asset space from back in like 2013 through like a bunch of funds. And then like, you know, we work with family offices. We do like a lot of different work around the digital asset space.
Awesome. Thank you. Let's get the ball rolling. The people who are attending that, if there will be 4 polling questions, and you need to answer 3 out of 4 to get the CPE, and we are registered with NASPA. So after this, the webinar, our team will send you guys the CPE certificate within the next week or so. Okay, let's digital assets. What is digital asset? Instead of asking a definition, Paul, to tell our participants, what do you mean by digital asset here?
Okay, so many of you guys know about Bitcoin, Ethereum, other kind of digital assets. Let me just give a high level description. Digital assets are assets that are managed on the blockchain, and these things have unique characteristics as it relates especially to tax questions. They allow people to transact without a third party to manage that relationship. They allow you to do it publicly, but also privately, and they allow you to transact kind of across borders. And so the digital asset marketplace today is a little under $1 trillion. It's been as high as $3 trillion, but these digital assets represent kind of an innovation in how we can interact financially. And so there's a broad swath of categories and functionalities to what they do, but I encourage people to just think of it as a technological advancement in how we can manage financial transactions, and really beyond that, much of our lives where we rely on third parties to make markets, we now have these digital systems that will do that.
Awesome. Celu, would you like to define in an easy way for the participants what's the digital asset in a simple way?
Digital asset, yeah. I mean, just kind of going off of what Paul said, you know, it's just kind of like this new category of financial systems. It's still super young, you know, like you keep hearing news about like, you know, this breaking, that breaking, because news media likes that. But generally, it's a very difficult thing to build a new financial system, and the fact that it's even possible is amazing. So it's probably going to take another 20, 30 years, and like every 6 months, it's going to look really different. So it's just kind of one of those things where you have to go in with an open mind, and just willing to be learning about it all the time.
Awesome. This is the same question to Kevin. I wanted to define through the legal terms, right? Digital asset. They gave us the meaning of digital asset from their point of view, being a fund manager. What did you think about digital asset? How would you define?
Yeah, I would say it's evolving, because with each few months, there's sort of a new variation of it that comes out. So, initially it was, Bitcoin and Ethereum and all these cryptocurrencies. It's obviously expanded to mean, certain virtual currencies that broaden beyond that. You start having like NFTs come into it. And so there's all these different types of, digital representations of ownership that you have to, with the legal definition, constantly tweak to include so that it's all inclusive. That's what we've seen.
Yes, this is one thing I know about this space is this is evolving, constantly evolving. Someone thinks this is the final result. I don't think so. I think we don't know what would be including in the next 10, 15 years in the definition of.
Yeah, I guess one thing I would add to that is, you start seeing digital versions of more conventional financial assets come into play. So like initially there's the cryptocurrencies, but then you start seeing, certain digital assets traded with leverage or using like crypto derivatives. And so suddenly there's variations of that need to be included. So it continues to expand, but it kind of mirrors what's already out there.
Okay, awesome. Good. So this is a big picture at this moment, but this sheet reflects only until the numbers up till December 31st, 2021. We know that we are all going through the crypto winter, but Steve, would you explain that how this thing evolves so far as of 2021, and then we can ask Paul to tell us about 2022 winter and where he see in the coming years?
Right. So through 2021, you saw exponential growth in returns in this, in this industry, and that's basically because interest rates were low. You were able to get big returns out of this. Everybody was putting their eggs in the basket, thinking, "Hey, we have this new toy. Let's invest in it. It's going up, 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 and up." And then all of a sudden, at the beginning of 2022, you saw the Fed start to tighten its grip on the economy. And, the biggest driver of the downturn in the crypto market is the Fed tightening its grip. So now is where, you had zero interest rates at the Fed. Now, what are we up to? 5, 6, whatever it might be, right? Right. So once you're that high, you're not going to take the risk here in crypto when you can, go to a T-bill, T-bond and get, guaranteed safe returns.
And
right.
I think the other biggest part will be the quantitative tightening instead of easing. Before 2021, they were printing money and more liquidity.
Yes.
Now they are evaporating the liquidity and also taking the punch ball away, right? So my next question to Paul is, obviously you have, and also to Celu, that there are bull markets and bear market in every asset class. What do you see so far, and how do you see the future in the coming years, that how people should consider this asset class in the big picture of the portfolio?
Yeah. So many of you won't be familiar with this term of a crypto winter, but I love it. It's a phase where people no longer believe in the technology. They feel like it's dead. There's no retail investment. There's no FOMO, and all of the capital leaves. To your point, I would add, Steve and Muhammad, I would add that like unlike many other assets, crypto is extremely liquid. You can withdraw it immediately. So it behaves very much like a risk on asset. And so in times of fear and trepidation, it's an easy way to become liquid. So during these crypto winters, people call it, a hoax. People say that it's like never coming back. You go to your family parties and everyone crap bags on you for owning it. And basically it kind of washes out people that don't have a real belief in the system. And so this is my fourth crypto winter. And it really takes a conviction that this is a transformative technology. And if you have that, then it allows you to allocate capital at a really generous price. I think there's a few things that I would note for this crypto winter specifically, some positive, some negative. Let me start with the positive. Unlike previous crypto winters, we now have over 10,000 developers actively working in this space. We now have the rails by which kind of big institutional investors can access this asset class. In 2017, you weren't going to see KKR collateralizing a healthcare portfolio on the blockchain, right? So it's a lot easier to come back. The negative, though, is that crypto started in 2009 in the midst of the global financial crisis, and it has never had to deal with, severe macro headwinds. And so that creates kind of some negative. If you would ask me a week ago, I would have said regulation was tracking positive as an on-ramp. I now think with the failure of FTX, one of the second largest global exchange, we're probably tracking towards negative regulatory environment. But all of these things, you have to dig deep and understand that fundamentally digital assets are a better way to undertake financial transactions than our existing system. And if you can remain committed to that, history has shown you'll be rewarded in your returns.
Awesome.
Yeah, and kind of going off of Paul again, I feel like if what he was alluding to, the crypto winter, like where like it's actually not fun. So only the people who love the field or the process actually stick around. And that's where you make the best investments. So usually how it works is that you go through the pain of the winter and you make your investments when it doesn't feel like it's a good move at that point, and then you sell during the hype. The crypto, the reason it's kind of spreading is that I think it's remarkably good at capturing speculation, tapping into human speculation. So and the way I've seen it work is like through the winter, like usually there's some kind of a new thing that people don't think is possible, and then nobody pays attention to it and it just gets built. Nobody really knows about it, and somehow like it gets viral, and then like when there's a lot of frenzy, like it just blows up into this huge thing. So if you keep learning about the space, you will run into it at some point, at some stage. And like the first wave was like even just Bitcoin itself, like people didn't think it was possible, and then like it kind of stuck around and proved resilient, so that blew up. Then came like in the next waves, there were other things like NFT or DeFi. All these things kind of come, and there is like huge opportunities in those. Obviously, they are all super young, so a lot of things tend to break as well. But if you're open to that, you learn a lot, and there's good financial reward. And one other thing is that if you see from the beginning, even though there is a lot of news about like the crash and all that, the upside is much bigger than the downside. And if you stick around, like 5 years, if you like plot all the like crypto winters before, and usually no matter where you get in, like 5 years, if you're sticking around and like you're active in the space and learning about it, you tend to do well.
Awesome. Okay, I think it's time for the polling question. So I'm going to start the polling question. Okay, so our first polling question was that tell us about yourself, and 100% people pick that category, finance professional. They didn't say crypto investor or digital asset fund manager. I believe it's difficult to pose that when there's a crypto winter. Okay, anyway, so let's come to the structuring thing, right? This is Kevin area of expertise. Kevin, please tell us about overall different types of fund structure and how it will different for the digital asset class, please.
Sure. So, I think there's kind of two layers to it. There's the fund structure you see with really any type of private investment fund, which is what you have outlined here. So standalone US fund versus an offshore fund, full master feeder, mini master. That's kind of universal for any type of fund. So with, if you're, and it's really driven predominantly by your investor base. So if you have, let's say, just US taxable investors, what's going to make sense is just a standalone US fund, Delaware limited partnership, very straightforward. What they really want is US, flow through partnership taxation. There's really no need to look up to anything offshore. Where it gets a little more complex is if you have non-US investors that typically prefer an offshore entity, or even tax exempt US investors if you're using any leverage that want to avoid EBTI. And so they'll want an offshore corporate blocker. And so that's where you see a lot of times a Cayman or a BVI fund to accommodate that subset of investors. And then from there, the next question is, well, how do you combine them all into a single fund structure? You can either have these two parallel funds, which might be less efficient because you can't do all the trading through a single vehicle. So what you typically see is what's called a mini master structure, where the offshore feeder invests directly in the US fund as an LP. Then you conduct all the trading through the US fund. Or you can add a third leg to that, where you've got the US feeder, the offshore feeder, they pool their assets in a third vehicle that's also offshore called a traditional master fund. And then you conduct the trading through that master fund vehicle. That was sort of the common structure years ago, and I think for a lot of fund managers, it's made sense to shift to the mini master structure. But then there's another layer for digital assets funds where would you like for me to kind of go into that as well? And
sure.
Okay. And then so what's unique about a lot of these crypto and digital assets funds is on top of that, it's how do you access certain markets? And so, for example, if you're a crypto fund manager that wants to access some of these non-US exchanges, because you can get better leverage and things of that nature, you might not be able to do that through a US fund because they don't want any US UBOs. They're trying to avoid CFTC regulation. And so there's, that can be tricky. We've seen a lot of different structures. Sometimes there's, an offshore vehicle dedicated to trading on those exchanges. And then you have the fund enter into some kind of agreement with that offshore vehicle, whether it's an orphan trust or just kind of some credit, loan facility. You have to look to each exchange, what's permitted, what's not. It gets pretty nuanced, but the point being, sometimes for that reason, you might want an offshore master fund in order to access these exchanges, and maybe even like another vehicle on top of that that can or cannot open accounts with some of those exchanges.
Okay, awesome. So now the question is, for when we're thinking about the mini master or master feeder structure, the offshore funds, there's a lot of fund managers have different options for different jurisdictions, right? So which jurisdiction is better than other, and what would people prefer? So Paul, you can tell us that what do you think about which jurisdiction is a better jurisdiction for the digital assets, if you have?
Yeah, so just to expand on the previous, on what Kevin said, for me, my decision to kind of set up in the Cayman was twofold. I needed full product suites that I couldn't obtain in the US, right? Like, and I want to make sure that that's, everyone understands that's not for a nefarious reason, okay? That's not like, crypto is not well defined through law yet, right? And so I felt kind of a responsibility to my investors to set up an entity that would allow me to trade and get exposure. And I didn't want to be constrained due to ambiguity of US exchanges. The second part of that is it gave me the flexibility. Crypto is also very global. So I can, as fund owner in the Cayman, I can fire the investment manager based in the US and I can move to Singapore or Dubai, and without causing disruption to my investor pool and manage the funds out of there. So my decision to work out of the Cayman was, you know, people always think like it's, oh, you know, you're trying to skirt regulation. I think with the case of digital assets, our government is unwilling to provide clarity on regulation, and so I didn't want that to impede my investors' ability to access. So that was my strategic decision. As far as the Cayman specifically, you know, it's been pros and cons. I mean, I think the AML KYC burdens, putting my US investors through that has been a hard conversation at times, right? I'm sure it's slightly more expensive. I envisioned being able to manage multiple strategies and to be able to build, grow. And so I thought Cayman had an existing structure with wonderful service providers, and we'll probably get into this at some point, but as a fund manager, who you contract with to perform services is probably the most critical thing to your fund running successfully. I'm gonna take liberty here and just, sorry, plug Muhammad and Steve. Like, I can't explain what it meant to me as far as certainty to actually find a group that could deal with and provide services to my investors. And so, like, just a huge plug for them. But running a fund has 7 or 8 service providers, and Cayman had a great place for that. Yeah. So again, one more horror story. Lots of times people who are into crypto, my background, I worked at Ernst & Young in the UK for 8 years and actually did valuations for tax purposes. And so I actually had a decent tax background, which informed my decision. Too often crypto managers think that they're good at crypto and they don't have to think about this stuff that Kevin is focusing on. And I've personally seen it multiple times where people set up the wrong structure for what they're trying to do, and then they're out a year in the market and they're out significant investment, and they've just put their investors through a horrible thing. So you better have a vision of what you want to do in your fund, and then work with people that actually know crypto to help you put in place what the vehicles and the services you need. Sorry, I went on a bit there.
No, I was just going to build on that. That's an excellent point. So, you know, I think not to generalize on any type of class of managers, but one thing that's unique to crypto is a lot of people that come into, you know, manage crypto funds may not have had as conventional of a, you know, investment management background, and that can be a very good thing. You know, that's why they've succeeded. They're coming at this from a unique angle. They really understand digital assets and crypto and are, you know, passionate about it. But sometimes the trade-off is that maybe they have less familiarity with some of the conventional fund structures. And so a lot of times, you know, if it's one of those types of managers that don't come from a traditional investment management background, there is an educational component where you have to bring them up to speed on why these structures are universal and why they, you know, a lot of it is tax driven and accommodating your investor base. And so that's kind of one consideration that's extremely important. And the other one is that crypto does bring, you know, unique considerations. Again, you know, how do you access some of these platforms that you may want to trade on that doesn't come up with, you know, a long short hedge fund? And just, you know, anecdotally, we've seen a lot of fund structures that, you know, worked with, and I'm not going to name any by name, but, you know, prominent, you know, investment funds practice groups that maybe didn't have as much experience working with digital assets and crypto fund managers, and set up something that's appropriate for a traditional hedge fund, but doesn't have some of these complexities that you need for a crypto fund. So I think, you know, finding the right service providers, and, you know, my own self-interest comes into play in terms of legal, but also, you know, a group like Muhammad and Steve for audit and tax, and finding the right fund administrator, finding the right banking provider is actually really critical, because it's a particular skill set that some providers have developed and some haven't.
Awesome. Thank you, Kevin and Paul, on this. Celu, would you like to add here? I know you know there more about the Dubai and Portugal. What are the pros and cons of those two jurisdictions?
Yeah, so, actually things are obviously rapidly changing, in terms of like regulation and like the news coming out. And since I would say like since last year, like Portugal they had like this happy accident. They didn't know that they were doing this, but because they didn't have a specific framework for crypto, like it fell under this umbrella where as long as they had a law where as long as you were trading crypto for your personal purposes, like it was exempt from taxes. So that kind of caused like a whole crypto migration like around about last year. But now actually they've deliberately like kind of, I don't know how long that's going to last, because they've kind of like started to the regulators have started to move on that, and there is some laws being discussed. It's another question if it's going to pass or how that might turn out. But that's where I think generally Portugal and EU like stand about like where EU is getting more deliberate about it. So all these kind of like crypto specific regulation laws that were used to kind of like make some of these decisions might go away soon. Portugal's like one of those, but they have like a general like good kind of like tax incentives and like a lot of different options for people, just digital nomads who just want to kind of like move. The country as a whole is very open to attracting new like industries, and like Lisbon's like thriving, has a lot of like early like probably LA vibes, like just people from all over the world there kind of. So that's a good energy. Just Portugal, like in terms of regulatory side, like yeah, it's still a work in progress. It's nothing set in stone yet. And in terms of Dubai, like Dubai, so the like one of our clients like set up a family office in Dubai, and Dubai DMCC actually is one of the only places that that I was able to find. This was again like late last year that knew even what DeFi meant. So like the family office operates like in like DeFi. So like it just like, so which means like there's like very quick transactions and need to be able to move on things really fast. And for places that were not even like aware of what was going on, it was just hard to explain, like just the burdens add up. But DMCC were very proactive about it. They are very like savvy with the latest stuff. They keep on top of it, and I think they were making a very deliberate effort to make Dubai like a home. I don't know if there's other entities in Dubai that issue crypto licenses, but DMCC has like a specific crypto license you can get, and which means that the company is only licensed to trade crypto. You can't do other stuff in the company. Generally, just me working with those folks like through the process of incorporation, it was like a really good experience so far.
So anyone knows about Singapore? I think Singapore is also trying to get some crypto business at the funds. One of our clients is registered over there. Paul or Kevin, do you know, have any experience or learn about the Singapore jurisdiction?
About Singapore?
Yes.
I'm familiar with it in terms of I've seen funds that were set up there. We haven't, as a group, set up any funds there. Our experience has been more traditional. So we've seen a lot of BVI and Cayman funds for the offshore jurisdictions, and then really just Delaware for US funds. There's been talk about Nevada and Wyoming and other jurisdictions, but our personal experience has been those conventional domiciles.
Yeah, the only thing I would add is just floating up one level. And maybe this is just me talking as a portfolio manager, but I always want to make sure that the tax tail doesn't wag the investment dog. Okay, so you figure out what you want to do, then being able to tell that to Kevin and Muhammad and Steve and saying exactly what you do, what your strategy is, that's your path to figuring out what jurisdiction will get there.
Right.
But that path is secondary. I mean, 6 months ago, Singapore was super into it, right? They're trying to attract everyone in the world, and then one of the largest crypto funds in the world went bankrupt, and the guys in Singapore are in the wind. They might feel completely different about courting that industry now. Bahamas, I was in the Bahamas, they were begging me to relocate the fund. FTX closes this week, that might not be available. So start with investments, then risk manage that decision to find like what matches with your investor base and what you want to do. And then you're relying on your service providers to find the best given the dynamic nature of this. That's how I would approach it if I had to start again today. I don't know that you have clarity as far as this is the panacea for what country, right? Like it's just too dynamic.
Right.
Yeah, I would add to that too. I mean, the ultimate goal is to, have superior investment returns and raise capital. And so if you're too hyper focused on like finding a unique jurisdiction where there's complex tax considerations, you have to sell that to your LPs. And so if it looks unconventional, I think the trade-off isn't remotely worth it. So I would just always factor that into it as well.
So, Kevin, my next question is, obviously 99.9% of funds are being domiciled in Delaware, the US fund, US structures. Yeah. Have you done in the state of Nevada? Is there any other state would you like to, other than Texas? And tell us about the jurisdiction.
Yeah, I think it's kind of the same point. So we've seen, we'll have managers come to us really interested in setting up in Wyoming or Nevada. And we can, but Delaware is entrenched as sort of the go-to jurisdiction. And so there's a few things that come with that. One is it does have, partnership and manager-friendly laws and courts. Other states may have equally friendly ones that have caught up. But then you also have investor optics in the fact that they typically prefer a Delaware LP. So just personally, I'm always kind of hesitant to move it to another jurisdiction. I think that, you're talking about marginal differences, but optically maybe considerable ones. And so we've had it come up. We haven't, as a group, launched funds in US funds in non-Delaware jurisdictions, but it's certainly doable, and I know it exists.
Okay.
Right. And I just want to let me add this: the same optical, what you're referring to, goes for BVI versus Cayman versus Portugal and Dubai, right? It's, everybody, gravitates toward Cayman for optics, and because it's been around so much longer, right? They're, especially the bigger institutional investors, they'll be more comfortable if they see Cayman as opposed to one of these other jurisdictions.
Right.
I will say on the Cayman BVI one, that 100%, and especially in the traditional fund space, we do see a lot of crypto funds also considering and launching in BVI. I just think there's something in that group where they're more open to it, but that's just us as a practice.
Okay.
Right. Okay. Awesome. So I would say ask first, Kevin, to you, right? Please tell us. This is more like SEC definition of token and CFTC rules, and then I can ask Steve to give us color on the tax side. Thanks.
Sure. So I think sort of one of the million-dollar questions with cryptocurrencies was, what regulatory oversight does that trigger? And the big one is, what's a security? When do you have to, deal with the SEC? And really what this is talking about is the fund manager need to register as an investment advisor at the SEC or state level, or rely on an available exemption. If you're investing in securities, it also triggers Investment Company Act considerations. And so, what we've realized, or what the SEC has essentially let us know, is that they're going to apply the existing investment contract analysis to these tokens. And so it's a case-by-case consideration. There's something that's been around for years called the Howey test, where essentially you have to determine whether you're expecting profits based on the actions of another person or other individuals. And so there was the DAO token that, they offered a lot of commentary on that, but it's really a case-by-case determination of whether it's acting as a security. There's been talk about, whether a token can sort of gravitate from a security token to a utility token. And there's, some commentary out there about Bitcoin and potentially Ethereum not being a security. But I think by and large, most of these digital assets are securities if you put them to the test. And so absent additional regulation, that's really the framework that we have to operate under. On the CFTC side, they've come out and said that, a lot of these are commodities. And so if you have, Bitcoin and other cryptocurrencies that are by the CFTC's definition of commodity, then anytime you use, margin or leverage or any type of crypto derivative trading with that commodity, then it falls under their jurisdiction as a futures contract. And so that's really the test there, is how you're trading it.
Steve, would you tell us about what the IRS says about the cryptocurrencies?
Yeah, so as we sit here today, the IRS is taking the position that it's not a security, right? Whoops, got some big there. It's really a what the heck is the word I'm looking for?
Not a currency.
It's not a currency. It's not a security. It's what's the word I'm looking for? My brain is shot.
Property.
It's property. That's it. It's property. That's what I was thinking of. It's right. They're considering it as property for now, right? And that may not change. Who knows what they're going to decide? I think they need to get their ducks in a row with the SEC and the CFTC and everybody else. Right now, they seem to be on the other end. So if you're trading it as property, your tax characterization of any of the income is going to be different than your book characterization of the income, and all that other fun stuff gets in the way, right? The good thing is, because they're treating it as as an asset, not as a security, you sort of bypass all the nonsensical wash sale rules and all the other stuff that goes around year-end tax planning for these things.
But also means digital assets will always generate capital gain, which is a different ordinary income or gain. So my question to Paul is, while Kevin was defining the definition in the SEC and CFTC, when you're making those trades, right, are you aware of that you need to register with the CFTC as a commodity pool operator if you trade derivatives? Can you shed some light on this?
Yeah. So this, and I ask Kevin for confirmation, but this starts at the prospectus level, right? Like, you have to articulate your trade strategy and you have to then follow that, right? And so for me personally, that's not relevant. My relevant question is, do I own securities? And there have been millions and millions of dollars spent to decide what individual holdings are and aren't securities. And so I just have to be careful with that, right? I just have to not be aware of any lists and things like that, and avoid. But I don't get pulled into that space based on the type of trading that I do. I will say though that if I was looking at this, my process would be clearly articulating your strategy, communicating that to legal that sets up the documents, adhering to that fully, right? Trying to avoid gray areas. And then I would even say documenting your thinking around where you're at with this as it changes. And so on that, like, I think you have to, and I don't know if you want to get into this right now, but how you trade and how you communicate that to your fund administrator, right, really does matter. And you have to, as a fund manager, take control of that. You have to say, here's what I'm doing. You have to consult your legal, your accounting, and really come to a consensus that you're making your best efforts to be compliant in something that's completely ambiguous, right? Like I can't just pick a holding and get a ruling on whether it's a security or not, right? So you know, this is, again, it seems like I'm stressing because it really does matter, because I've seen it with people that don't. You don't get to just operate in a vacuum because it's crypto. You have to really take the reins as a fund manager and challenge your service providers to give you the best answer they can, and then move forward with a little bit of regulatory ambiguity, but being able to demonstrate that you didn't do anything with the purpose of taking advantage of rules, right? You were consistent, you followed your methodology. So to take a specific transaction, right? Like I want to do something, I trade it, and this matters because in crypto, there's all kinds of new products. Like I can't stress enough. We have things like liquidity pools. We have liquid staking. These are things like the SEC is having an 8 years ago conversation where, and we're dealing with products that are made up in the last 3 months, right? I don't want to not trade those as a portfolio manager, but I have to look at the economic characteristics of those. I have to communicate that with my tax advisor and with my legal. And then most importantly, I have to dictate to my fund administrator how I want that treated. Too often, like, I mean, multiple times, and I have a really good fund administrator, multiple times I've had to explain to them what I'm doing and how I want them to treat it. And I think if there's one takeaway I have, if you're not in control of that, then you're opening yourself up to kind of regulatory risk and real problems for your investors as they try and communicate with tax authorities what the hell they've done in the most efficient manner, right? So I've kind of said a lot there, but my main point is to just say, you have to act in good faith. You have to act with consistency, and I would say with a moderate amount of conservatism. Don't go pushing the envelope on what you invest in, because more regulatory oversight is coming.
Yeah,
so I've said a lot there.
No, I think conservatism is the right word there. Not because you always have to be conservative with all these approaches, but in this particular instance, what we're talking, a lot of times, I think similar to what we said, like the tax tail wave, wagging the dog, it can be the same thing here. We have someone that comes in and they want to argue that the positions they have are not securities. And you have to explain, well, these specific cryptocurrencies are not tested, but if you apply the Howey test, it's most likely that one or more of these are securities. And so it would be very aggressive to take the position that are not. That's where if there's ever an inquiry or an investigation, you could get dinged for not complying with the Advisors Act or with the Investment Company Act. So generally, absent very limited circumstances, you really have to kind of make the assumption that most of these assets or some of them are securities and treat it like really any other fund in that respect.
Kevin,
yeah.
let me just. This is the exact instance you should always be in. Your lawyer should always be saying, you can't do that. And this is what like the SEC is relying on, is this ambiguity, right? Because you could, like, it's not my job as a portfolio manager to apply the Howey tests because I don't know how to do that. And legal is very hard pressed to kind of get a ruling and get something tested. So you have to just, have to be conservative, but you also, I just don't know that I would just end up only doing Bitcoin because the CFTC has said it's that. You have to, you have to work in this space.
So I think let's jump on the polling question because we have 5 minutes left, and we can expand that. So let's go for a polling question quickly. Okay, so our question was, did you generate a positive return in 2022 from your investments in digital assets? So I would say 100% said no. So it seems like it is correct. Because the reason I put this question in the polling, because that's how IRS look at. If you file the tax return and say you suppose you file 2021 tax return and you said I have losses, didn't make any money, it will be difficult to digest for the IRS, because if you say you lost one in 2022, they know that market was brutal and they were expecting you to. They are not expecting you to generate a loss in 2021. If you're doing that, it means it's most probably you will get be audited. So let's get the ball rolling. Steve, so obviously you discussed earlier, but tell us about the war sale rule and also the 1031 like-kind exchange. Do they exist in this environment for the digital assets?
Right. So the wash sale rule goes out the window here. There's no concept of it, because for the IRS purposes, you're trading a piece of property, not a security, right? You're not trading a stock or anything like that. So you don't have to worry about that. A 1031 exchange, I believe you can do, right?
1031 exchange is not allowed. The reason is when when the investors or fund managers or the taxpayers buy digital assets through the fiat currencies, most of the base currencies in the digital space are Ethereum and Bitcoin. When they change from base currencies to other coin, they can't take a position. A lot of taxpayers and the fund managers, they said, because they didn't convert into the fiat currency, so it's a like-kind exchange. No, this like-kind exchange rule, 1031 exchange, doesn't work here. So whenever you exchange or change one coin to the other, you need to determine gain and loss. So this 1031 provision is more available for the real estate professionals, but people try to implement that here, but that was a wrong approach. So please don't do that. This is a very risky tax position to take. Let's jump on 475. Steve, can they take 475 F election mark to market in the digital asset space?
There's no concept, because everything is already, it's an asset. It's already ordinary.
No, 475's mark to market election is available only for securities, right?
That's right. That's what I said. The coin is not a security.
Yeah. So the coin will generate capital gain, and you can't make this 475 mark to market election convert your capital gain into the ordinary gain or loss, right? It won't happen. So 475 mark to market election is only applicable to securities, and digital assets are not securities, so that's why you can't make mark to market election.
Right, and that's the first thing I mentioned, right? Because it's not a security.
So it's time for the third polling question. So let's launch this. Okay, so our question was, how was your digital asset annual return in 2021, right? I have different brackets, but my highest bracket was 100% and above. So it seems like majority of the people chose that option, which is in line with the market, how the market was trading during 2021. Okay, so that's the other topic I want to discuss here is, and that's pretty common, right? And Paul, you can also tell us that when you launch those crypto fund, a lot of people they want to contribute into the fund, but they don't want to give you fiat currencies. they want to give you their digital assets. That's called contribution in kind in the fund. So there are tax ramifications for that, right? So how do you deal with your investors when investors say, yes, I want to invest in your fund, but I don't want to give you cash, fiat currency, I want to give you digital assets. What's your usually response to that?
So I do take in-kind contributions, and I refuse to provide tax advice to them for that.
Right.
So that is their decision. I highlight that there may be tax effect for that, and I invite them to do that. But I feel that very strongly that that's outside of my purview. The only other practical item is you need to be able to make sure that your fund administrator, your bank, and your exchange is able to onboard in that way. And probably, Kevin, correct me if I'm wrong, you probably need that explicitly stated in your docs, how in-kinds are treated. But I'm one of those people that spent 10 years at Ernst & Young, and I know enough about tax to be dangerous. And so I am very, very clear to steer them to Muhammad and Steve before I do that. But it doesn't hurt to be aware. And this is where crypto people might get in trouble, is you can't just you owe it to your investors to just highlight that this might be something that they need to take a position on.
Yep, agreed. And like you said, it's something that needs to be specifically disclosed in the memorandum, letting them know whether you accept in-kind contributions in the first place, to sort of the potential risks involved, and really always punting it back to them that they're going to have to consult their own tax advisors to make an independent decision.
Generally, there is no recognition of gain upon contribution of digital assets into the fund, as long as that contribution doesn't result into the diversification of transfer assets. So there's a diversification test we need to do in order to take that position. Have you seen, Paul, your investors are asking you to do the same thing? Don't pay us in fiat currency, pay us in coins, right? In digital assets. Have you done that?
So I'm fortunate to not have any redemptions yet, and so touch wood, hopefully that continues. But we do make it available through our docs, and that would be a process I would want to work through with our fund administrator on the methodology. I haven't seen it. I would probably, if I had my own choice, would steer people just to a cash. If someone wants out, they want out of digital assets, right? So I don't see a need to kind of take them through that. And I personally wouldn't want to deal with kind of the addresses, and I take on a certain amount of risk that I can execute that for them. So if I had a choice, I would do it through the banks, but it is available, and I just haven't had to deal with how they think about it or how they treat it.
Again, this is fund manager needs to discuss with the law firm or the fund attorney, in this case Kevin. Kevin would mention that in the legal documents, yes, contribution in kind is available, distribution in kind is available, but that will cause more struggle on our side. Then we need to make sure that it's not a taxable event, and we need to do all those tasks to make sure, right? Usually distribution in kind is not a taxable event because you're not receiving in fiat currency. But it's still have to determine the cost and the market value of those securities mentioned on the notes, but just to keep in mind. So next topic, we have 5 more minutes and then we need to wrap this up. There was Steve, recent legislation were passed, right?
Yes.
A year ago, right? And what areas did they touch on that?
Right. So the big one is, as it stands today, you're receiving a 1099-K for your the amount of transactions and the actual dollar amount, not gain, not loss, not cost, not anything else, but pure dollar amount of your transactions, whether that's one transaction for $1,000 or 10,000 transactions for $1 million. Going forward, you're going to get, just like the broker gives you for your securities, you're going to get a 1099B for your crypto activity. So what's happening is the IRS is now going to know, hey, ABC entity, got a 1099B. Let me see it on the return. How did they handle it? Right? It's all going to be traced, and it's all going to go back to those wonderful questions at the beginning of the tax return. Did you buy, sell, or hold any crypto assets during the year? And they'll compare that, they'll cross-check that to the 1099B in the same way that an individual tax return gets cross-referenced with K1s they receive. Right? That's really the big one.
Right. Because IRS has not mentioned any rules yet what document would be in, but we're just guessing that it would be similar to 1099B. But keep in mind, they might come with a different
Right.
tax form number, right?
Right.
Other is that when you receive digital assets, right, more than 10,000 value of, I think they said that digital asset would be treated as a cash for purpose of statutory requirement in excess of $10,000. So this applies to every businesses. Any business who has received more than $10,000 of digital assets has to report that and fill out that form. So IRS would know. So there is a lot of right before in every economy there is a digital economy, there's a cash economy, and there is on the books and off the books, right? So this space was for a long time period was not being targeted, but now this digital asset space is being targeted, and it means it will be like a digital, right, economy. Everything is being captured by the third-party payment processor. So I think these exchanges are going to report everything you're going to do. So be careful when you file your tax returns. You are not lying, and you are always file your tax return under the penalties of perjury. So make sure, and that's Steve brought the question that you need to tell yes or no if you buy, sell, purchase, trade any securities or not, right? I would say the biggest thing was that they mentioned that whenever you're going to transfer assets, even to your wallet or wallet to exchange, those exchanges have to report those cost bases. So the problem at this moment is IRS only knows the proceeds. They don't know the cost of the digital assets, because in a regular 1099B document for stocks and bonds, they know how much the cost is, how much the proceed is, so people can determine gain and loss. At this moment, only 1099K tells you the proceeds, doesn't tell you anything what the cost is. So it's very difficult to determine gain and loss. But with these changes in the law, I believe most will be effective in 2023. Now, when we file the tax returns in 2024, these will be applied. And they also increased the definition of digital assets. They included NFTs. So means they broadened the overall network or the definition of digital assets. So I would say it's almost 1 hour. I would thank you all my panelists, Kevin, Paul, Steve, Celu. Before we go and finish this conversation, I would ask everyone, give one piece of advice to managers or finance professionals who want to launch a crypto fund in the next 5 to 6 months, what they should do. Kevin, go ahead.
Yeah, I would say that the most important decision you make is which service providers you align yourself with. I mean, obviously we're all, we have self-interest in that statement, but it's just really true. It's a very specialized space. Find the right legal counsel, find the right fund admin, find the right auditor, really do your diligence in interviewing them and kind of getting their understanding of the industry. because there's sort of, traditional investment funds, and the digital assets and cryptocurrency funds add a whole level of complexity to it, where you really want to make sure you're partnering with the right people.
Paul?
Yeah, I would just say to just be aware of the entire asset management process, and you're in an environment where if you're going to raise money, you need to articulate risk, and you need to raise money that matches your long-term belief in the space, and really be able to assess whether this is the right move given the crypto winter, given what you do. Match that. If you onboard the right investor base and you can come off intelligent as far as how you use those service providers, and you can really appeal to them as far as like, hey, this is a way to get crypto without having to deal with these tax issues. Doing it through a fund is a wonderful way to not have to answer all these questions, right? And have a long-term perspective and go raise accordingly, but raise for a long-term narrative.
Okay. Steve?
Right. I would say keep your eyes on any regulation that is being talked about and potentially coming down the line, and already be prepared for it. Make sure that you're ahead of the curve, not behind the curve, right? And obviously that includes, speaking to your legal counsel, speaking to your service providers. Just, you'd rather be in front than behind.
Okay. Celu?
Yeah, I mean, it's very important to plan to get through crypto winters. So the ones that actually make the high returns are the ones who deploy capital through a crypto winter and come out on the other side and like get out at the right time, and being able to play the market. So just being aware of like the macro conditions and being able to align your strategy with that, I think is going to be like super important in the next 3-4 years.
Awesome, thank you. This is the last polling question I have to ask because of the NASPA requirement. Give me a second, I can launch this. Okay, awesome. My last question was, did you enjoy our webinar? 100% said yes. Not sure true or false, but yeah. So I would say thank you everyone joining again. I really appreciate your time and educating everyone in the digital asset space. So we will have more webinars to come. Please stay tuned. Check our website. Again, thank you, Kevin. Thank you, Paul. Thanks, Steve. Celu. Bye.
Thank you, Muhammad.
Thanks for having me.
See you guys.
Thank
Enjoy
you.
it.
Take care, guys.